Welcome to Dr. Fred Markets. This is not financial advice. Most people will never understand how crypto, AI, and global finance are reshaping the world. The rules are changing, and the ones who adapt early come out ahead. You're here. You're paying attention. That already makes a difference. Let's go.
Taylor Swift's wedding is better market intel than your ETF. Here's the tell. Luxury wedding spend in the US is up mid-double digits since 2021, while broad retail is flat to negative after inflation. The top 10% are throwing six-figure ceremonies like confetti, and vendors are booked out for 18 months. That's not vibes. That's a balance sheet screaming. Rich households don't care about your recession takes. Now zoom out. The S&P 500 is up around 17% year-to-date, but it's not just AI juicing the numbers. Luxury, travel, and experience stocks quietly push fresh highs while consumer staples and dollar stores bleed. The market price is in one story. The top of the income pyramid is in its own bull market, and they're the ones who own the assets. Third signal, casino and gaming names. Go look at the numbers. U.S. casino revenue hit a record in 2023, over $66 billion, and 2024 is tracking higher again. High-end Vegas properties are reporting room rates 30 to 40% above pre-COVID with no vacancy problem. Junkets are back. High roller tables stay full while financial Twitter whines about uncertainty. So you've got luxury weddings exploding, the S&P levitating on the backs of experience and status brands, and casinos printing record take at the exact moment the news cycle blasts you with shootings, scandals, and political chaos. Here's the uncomfortable question. If the world is supposedly on fire, why are the rich partying harder than ever? Because the actual trade of this decade is brutally simple. Assets versus anxiety. The news sells anxiety. Markets monetize assets. Taylor Swift sells out stadiums at $800 a ticket while headlines scream about doom. That gap between narrative and behavior is where the real signal lives. Let's dissect it. Signal 1, weddings. The average US wedding hovers around 30 to 40K. But luxury tiers are easily 150 cal plus. Those aren't financed on credit cards. That's stock option gains, private equity exits, and RSUs vesting. When that cohort keeps upgrading venues and paying for private security and destination weekends, they're expressing one thing: they trust their future cash flow more than you trust next month's rent. Signal 2. The S&P loves this. Look at the sector mix inside the index. Luxury conglomerates, high-end travel, airlines, live entertainment, high-margin consumer brands. When people with money decide experiences over stuff, those margins expand. No discounts, no coupons. You either pay or you stay home. The index is now quietly a tax on FOMO. Signal 3, casinos and gaming. These places are the purest real-time risk sentiment meter on Earth.
Let's pause for a second. Ask yourself this. Do you really understand what's happening in the markets right now? Do you know how this affects your money, your savings, your future? Most people don't, and that's exactly why you're here. Let's keep going.
When serious downturns hit, handle drops, high roller rooms thin out, and comps go through the roof to keep whales on property. That's not happening. Instead, net gaming revenue hits records while balance sheets repair. People aren't just gambling at tables, they're gambling that tomorrow looks enough like today to keep blowing money. Put the three together, and you get the truth. Your bearish friend refuses to accept. The people who own the assets are not scared. At all. They're using your fear as liquidity. While you panic over headlines, they rotate deeper into experience monopolies, the businesses that tax aspiration. Weddings, concerts, resorts, gambling, high-end travel. These firms don't care who wins elections, they care who books the suite. Here's the one thing you learned today. Discretionary spend at the top tells you more about the next 5 years than any recession talk on CNBC. Mechanism is straightforward. Money flows from anxious savers into safe bonds and cash. That money holds down yields and supports high asset prices. High asset prices make the top 10% feel invincible. They spend more on weddings, trips, and tables. Those sectors report blowout earnings. Index funds rebalance even more into those winners. Your 401k ends up underweight exactly the stuff actually expressing confidence because you keep playing it safe. So what do you do with this? Again, not financial advice, but here's the truth. First, stop treating headlines as data. Treat spending behavior as data. If casinos, luxury weddings, and experience companies keep printing record quarters, the real economy for asset owners stays risk-on. Second, audit your own portfolio exposure to aspiration tax businesses, not just luxury brands. The venues, platforms, and operators that monetize big emotions, weddings, travel, live entertainment, gaming. Start with an index or ETF if you're lazy, then peel the onion on which names actually have pricing power. Third, use fear as your entry discount, not your worldview. Next time the timeline melts down over politics, scandals, or the latest crisis, don't ask, is the world ending? Ask, are the whales still booking suites and weddings? If the answer is yes, the game isn't over. It's just charging higher cover. The market doesn't care about your feelings. It cares who's still buying bottle service when everyone else is doom scrolling. You can either be the person tweeting about collapse, or you can quietly own the businesses selling champagne at the after-party. Choose your side. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.